Here's something that might be hard to hear. Study after study shows that the average investor underperforms the very ETF they invest in by around 1 to 2% per year. In fact, Morningstar's latest research from 2025 found that over the past decade, investors earned 7% per year, while their funds returned 8.2%. That gap might not sound dramatic, but over time it adds up to losing around 15% of your potential returns. Not because ETFs are bad, because fees are too high, or because investors pick the wrong fund, but because of what happens after they invest. Most of these investors genuinely believe they're doing everything right. They opened a brokerage account, picked one or more low-cost ETFs, perhaps even set up a recurring investment and told themselves they're investing for the long term. And yet, their returns usually fall short of their index. So let's find out why most ETF investors still end up underperforming, especially here in Europe, even though it looks like they're doing everything right at first glance. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years together with my wife, following a simple, passive buy and hold strategy. And before you ask, yes, I've made my fair share of these mistakes myself, so this isn't me lecturing you in any way. The biggest enemy of ETF investors isn't market crashes, inflation, or even fees. It's behavior. There's a concept called the behavior gap, the difference between what an investment delivers and what investors actually end up earning. And this gap exists even with passive ETFs. No, especially with passive ETFs. Because when something is so simple on paper, like just tracking an index of stocks with your ETF, we tend to underestimate how hard it is to stick with it in real life. It often starts with something that feels very reasonable. You have money ready to invest, but the market is at all-time highs. So you tell yourself, I'll just wait a bit, maybe for a 5 to 10% pullback, then I'll buy. That sounds smart, like a patient, disciplined approach. But here's what the data actually shows. Markets spend a surprisingly large amount of time at or near all-time highs, which shouldn't be that surprising if an asset trends upwards over time. And historically, new highs are usually followed by more new highs. In fact, since 1988, investing at a record high actually led to better average returns over the following 6 months to 5 years compared to investing on any random day. So while you're waiting for that 5% drop, the market might rally another 10%. Then, when it finally drops 5%, you're still buying in higher than you could have if you had invested right away. And that's assuming you actually follow your plan of buying when it drops. Because when markets fall, we start seeing scary news headlines. Suddenly you feel like that 5% drop could turn into 10%, maybe even 20%. So you wait a bit longer and longer. I used to obsess over this myself when I started investing, convinced that waiting just a few more days or weeks would enable me to get my ETF shares cheaper. I can't tell you how often that strategy backfired, and I ended up buying at a higher price because that perfect moment never came. Now, close to 9 years into our investment journey, my wife and I have a very simple rule. When we have money that's meant to be invested, it gets invested as soon as possible. It doesn't matter if the market is up, down, or moving sideways. We actually just did this with 14,000 euros recently on Interactive Brokers and Trade Republic, after selling some Bitcoin to bring our allocation to this high-risk asset back down to our 10% target. We also have an automated recurring investment running at the start of each month. No checking charts, no second guessing. The decision has already been made, which is honestly a great way to stop the temptation of trying to time the market. By the way, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Another pattern I see constantly is rearview mirror investing. It's normal to want to invest into whatever performed the best recently. After all, none of us want to miss out. And we have the tendency to project recent returns into the future as well. But most of the time, this turns out to be a mistake over the long run. In the 1980s, Japanese stocks looked unbeatable, making up almost half of the global stock market by 1989. In the early 2000s, the US market basically went nowhere for a decade, while emerging markets delivered outstanding returns. And yet, if you had heavily tilted your portfolio toward Japan or emerging markets after those strong runs, you would have significantly underperformed the global market as a whole in the years and decades that followed. The same could happen to US stocks at some point if you're now thinking about going all in there because of their current dominance. I'm not saying it will. But I'm also not willing to bet my entire retirement on a single country. Since there's no reliable way to know ahead of time which region or market will outperform next, my preferred solution is to simply buy the entire haystack, meaning the global stock market via a single ETF. Historically, this approach delivered exceptional returns over the long run, and the whole point of a globally diversified ETF is that you don't have to guess. You own the US while it's winning, and you'll automatically own whatever wins next, whether that's Japan, India, Europe, or something else entirely. My wife and I stick to a single global ETF exactly because we don't know who is going to win the next decade or the decades after that. And we've accepted that we don't need to know. But even investors who stick with a simple ETF sometimes fall into another trap. They get bored. I get it. Simply buying and holding on to one or two ETFs may feel too simple, like you could be doing more. So you start adding things like factor ETFs for small cap value and momentum, fine-tune your allocation to specific regions, and add a bit of gold as that performed well recently. All of a sudden you're holding 6 ETFs instead of 1. On paper, this looks sophisticated and optimized. You've done your research on each allocation and historical backtests look promising. But here's what backtests don't show you. Complexity creates more decisions, and more decisions usually lead to worse behavior. Think about it like a gym routine. There's always that person with a perfectly optimized 6-day workout split. Monday chest, Tuesday back, Wednesday legs, and so on. Scientifically designed for maximum results. But what happens when life gets in the way? They miss a session, then another one. Suddenly, the whole plan feels broken and they get frustrated. And eventually, they stop going altogether. Meanwhile, someone doing a simple, full-body workout 2 or 3 times a week just keeps showing up, month after month and year after year. If you have to skip a workout because you're sick or life happens, you know exactly how to get back on track because your plan is simple. Investing works the same way. When you have a complex portfolio with multiple ETFs or individual stocks, every component that underperforms becomes a decision point. Small cap value might lag for 5 to 10 years. Gold might go nowhere for 27 years like it has in the past. Will you actually keep buying these assets, and will you stick to your rebalancing schedule when that happens? Every additional ETF or individual stock is another opportunity to second guess yourself, another chance to tinker. And tinkering kills returns, especially when you factor in capital gains taxes. Research consistently shows that the behavior gap gets worse as strategies become more complex. Even Ben Felix, who is probably the best known advocate for factor investing on YouTube, regularly mentions that the best strategy is the one you can actually stick to over the long run. I'd argue that for most investors, including my wife and I, keeping things as simple as possible, for example via a single global ETF, is likely to lead to better long-term results on average. Whenever you have money to invest, the decision is simple. You know exactly what to do. That being said, if you prefer a more complex portfolio, which you feel gives you more control, and you have the discipline to stick to it over the long run, then keep it that way. I'm not trying to change your mind. Another source of underperformance is dividend chasing. Receiving regular dividend payments feels good. It feels like you're making progress and generating income. For some investors, especially new ones, seeing this cash flow can provide a sense of stability and peace of mind, helping them avoid impulse decisions like panic selling during downturns. But sadly, in most European countries, dividends are taxed immediately, even if you don't need the money. This tax drag compounds negatively over time compared to accumulating ETFs, which automatically reinvest dividends into more shares of the stocks they hold, raising the ETF's share price by that amount instead. Not only that, if you go one step further and focus on high dividend yield ETFs, you may be excluding all of the most innovative growth companies and heavily overweighing sectors like financials, which is fine if that's your goal and you're trying to deviate from the market on purpose. Just make sure you're aware of what you're holding. Ultimately, there's nothing wrong with prioritizing dividends in your strategy if that's your preference. But generally speaking, chasing yield instead of focusing on total return is another way many investors quietly fall behind their index, especially when you take taxes into account. But here's the thing, all of these mistakes, waiting for dips, chasing recent winners, overcomplicating things and prioritizing dividends often have the same root cause. A lot of investors have no clear answer to a simple question. What are you actually building toward? You need some kind of goal, a number, an approximate timeline, or simply a clear reason for why you're investing. As a quick reminder, your time horizon when investing in the stock market via ETFs should be over 5 years, ideally 10 years or more. Because if you're planning a large expense like a house in a few years with that money, you might be forced to sell at a loss. loss, which completely defeats the purpose of investing. Money you need in the short term doesn't belong in the stock market. Keep it in a high-yield savings account or Euro money market fund instead. But assuming you're investing for the long term, here's what changes when you have a clear goal. You don't get easily distracted by the latest stock, sector, ETF or crypto that's being hyped up at the moment, because you know it might set you back years if it doesn't work out. You don't suddenly abandon a global strategy that was meant to last decades just because you don't like a country's current president or disagree with some policy decisions. And when markets drop 10 or 20%, instead of panicking and selling, you zoom out, look at the long-term picture, and continue investing as planned. Perhaps even viewing it as an opportunity to get more shares for the same amount of money. My wife and I have a specific goal we've been working towards since 2017. Early retirement in our late 30s. Based on our current expenses as a family of 3 and a 4% withdrawal rate, that number is around 800,000 euros right now. When someone asks me questions like why I don't invest only in the S&P 500 or why I don't primarily focus on tech companies as those have been performing so well recently, I ask myself a very simple question. Does this reliably increase my chances of reaching our goal and staying there once we start withdrawing from our investments? Most of the time for me, the answer is no. As I mentioned earlier in the video, the future is uncertain. We have no idea which companies and regions will perform best in the coming decades. That's why for me, investing globally and owning the entire haystack of publicly listed stocks makes the most sense. Not just at this stage while we're building our wealth, but also once we're retired. This also reduces the need to make big changes later, which helps minimize capital gains taxes as our life circumstances change. Look, if you recognize yourself in any of what we talked about today, don't be too hard on yourself. These are incredibly common mistakes, most of which I've made as well. Just make sure you reflect on whether they're worth repeating in the future. Here's something that might sound counterintuitive when compared to most other areas in life. Long-term investing in the stock market should be boring and simple. That's because putting in extra time is unlikely to increase your returns. It's actually more likely to have the opposite effect. Another benefit of having a simple portfolio is that it frees up your time and energy for other areas, your work, your family, and everything else you value most in life. Even though I'm running this YouTube channel about personal finance, I spend only a few minutes per month on our actual investments. The most important decisions about our strategy were made years ago. Everything else since then was just execution. I'd argue this approach has served us very well so far. As for most investors underperforming their ETF and its underlying index by 1 to 2% per year on average, that's completely avoidable. Not by continuously searching for the perfect ETF or timing the market, but simply by having a plan you can actually stick to. You can find links to my favorite low-cost brokers in Europe like Interactive Brokers down below in the description, which is a great way to support me if you'd like to. And if you're wondering which world ETF I would pick if I was starting over in 2026, make sure you watch this video next. None of what I mentioned today was meant as investment advice, and just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.